If your retirement income is over $93,454, you could be losing part of your old age security. And there's a hidden trap with dividend income that could make this worse than you think. In this video, I will show you how to avoid OAS clawback. I'm Tony, a CPA and financial planner here in Canada. I'm glad you're here. The OAS clawback catches thousands of Canadians off guard every year. You've worked hard, you've saved diligently, and then you discover the government is taking back some of your old age security because your income is supposedly too high. OAS is a monthly payment from the federal government that you can start receiving at age 65. Unlike CPP, it's not based on your contributions throughout your working years. It's based on how long you've lived in Canada after age 18. If you've been here for at least 10 years, you likely qualify for a partial benefit. For 2025, the maximum OAS payment is around $8,800 per year. That's about $733 per month. When your individual net income exceeds $93,454, the government starts taking back your OAS. The formula is simple but painful. For every dollar you earn above that threshold, you lose 15 cents of your OAS. If your retirement income is $100,000 per year, you're $6,546 over that threshold. Multiply that by 15% and you lose $981 of your OAS that year. At the extreme end, if you're between 65 and 74 and your income reaches $151,668, you lose your entire OAS benefit. If you're 75 or older, that full clawback happens at $157,490 because you receive a slightly higher OAS amount. One more important detail. The clawback is based on last year's income and it doesn't kick in until July of the following year. So if your income goes over the threshold in 2025, you file your tax return in April 2026. Then starting July 2026, the government begins deducting the clawback from your monthly OAS payments. This timing gives you a planning window, but you need to be proactive. The clawback is calculated using your net world income before certain adjustments. What counts towards this number? Employment income if you're still working, RRSP and RRIF withdrawals, CPP and QPP benefits, rental income after expenses, capital gains, but only 50% of the gain is taxable. And here's the big one, investment income from dividends and interests. If you receive $10,000 in eligible Canadian dividends, the government doesn't count it as $10,000 on your tax return. They apply what's called a gross up. They increase it by 38% for tax purposes. So that $10,000 in actual dividends you received counts as $13,800 of income for OAS clawback purposes. Now the good news. Some income don't count. TFSA withdrawals, completely tax-free, gifts and inheritances, return of capital distributions from certain investments, life insurance proceeds. So what can you actually do about this? Let me walk you through 6 strategies. You don't need to use all of them. Pick the ones that fit your situation. Strategy 1, build and maximize your TFSA. This is your most powerful tool. TFSA withdrawals don't count as income, which means they can never trigger the OAS clawback. If you're in your 50s or early 60s right now, maximize your TFSA contributions every year. When you retire, make your TFSA your first source of income. Draw from it before touching your RRSP or RRIF. Here's an advanced move. If you're between ages 60 and 64, not working or in a low tax bracket, consider withdrawing money from your RRSP and moving it into your TFSA if you have contribution room. Yes, you pay tax on that RRSP withdrawal in the year you take it. But once that money is in your TFSA, all future growth is completely tax-free. And more importantly, When you withdraw it in retirement, it won't count towards your OAS clawback calculation. Strategy 2, restructure your investment portfolio. Remember that dividend trap I mentioned? Here's how to fix it. If you currently hold Canadian paying stocks in a non-registered account, consider moving them into your TFSA or RRSP, where the dividends won't affect your taxable income. In your non-registered accounts, shift your focus to investments that generate capital gains instead of dividends or interest. Here's why this matters. A $10,000 capital gain is only 50% taxable, so it adds $5,000 to your income. But $10,000 in Canadian dividends gets grossed up and adds $13,800 to your income. That's a massive difference when you're trying to stay below $93,000. Strategy 3, use pension income splitting. If you're married or in a common law relationship and you're both 65 or older, you can split up to 50% of eligible pension income. This includes RIF withdrawals, registered pension payments, and annuity income. Here's an example. Janet has pension income of $110,000 and her husband has $40,000. Without splitting, Janet is well over the OAS clawback threshold. But with pension splitting, she can allocate $35,000 to her husband. Now, they both report $75,000. Both are comfortably below the threshold, and both keep their full OAS benefits. This one strategy can save couples over $1,500 per year in protected OAS benefits. Strategy 4, withdraw from your RRSP strategically before age 65. If you retire at 60 with a large RRSP, let's say $300,000 or more, consider withdrawing more than you actually need between ages 60 and 64. Why? Because those withdrawals won't trigger an OAS clawback. You're not receiving OAS yet, so there's nothing to claw back. The goal is to shrink your RRSP before you're forced to convert it to an IRF at age 71. When your mandatory withdrawals begin at age 72, smaller account balances mean smaller required withdrawals, which help you stay below the OAS threshold later. And if you have TFSA contribution room, you can take that RRSP withdrawal, pay the tax, and immediately contribute to your TFSA. You're essentially converting taxable future income into tax-free income. Strategy 5, time large income events carefully. Big one-time income events can push you over the threshold and cost you thousands in OAS benefits. Capital gains from selling a rental property, a cottage, or large investment holdings all count as income in the year you realize them. If you're planning to sell a property or cash out a significant investment, do it before age 65, before your OAS starts. That way, even if it pushes you over the threshold, it won't affect OAS because you're not receiving it yet. Strategy 6, consider delaying OAS to age 70. You don't have to start OAS at 65. You can defer it up to age 70, and for every month you delay, your benefit increases by 0.6%. That's 7.2% per year. If you delay from age 65 to age 70, your OAS payment increases by 36% for life. This strategy works best if you're in specific situations. If you're still working at 65 with high income, if you have good health and family longevity, or if you have a large RRSP that will generate high income in your 70s. By delaying OAS, you avoid the clawback during your high income years in your mid-60s, and you get a permanently higher benefit when you start receiving it. If you're approaching that $93,454 threshold, pick one or two of these strategies and start implementing them now, especially if you're in your early 60s. The decisions you make today about TFSAs, RRSP withdrawals, investment structure, and when to start OAS have a ripple effect that can protect thousands of dollars in benefits over a 20 or 25-year retirement. I'll see you in the next video.